Hello everyone, this is Kevin Zhao, your finance professor at MTSU. To gear up for this class, I want you to get two things ready. The first one is the textbook. The textbook can be purchased at MTSU bookstore. It's called a Corporate Finance Principle Finance 31. It's the MTSU version of the textbook. You may purchase, use the book. No access code is required. Once again, no access code is required. And the second choice is to purchase the original textbook called Introduction to Financial Management, 8th edition by Ross, Westfield, and Jordan. Right? And you don't need access code for either of those two textbooks. And the second thing that you need to get is calculator. Right, not the scientific calculator that you had in before. It's financial calculator. It's a financial calculator called Texas Instrument BA2 calculator. You do need this calculator to deal with most financial problems that you will come across in this class. Right? So I want you to get this calculator as soon as possible. Where to get it? I think the most convenient place for you to get this BA2 calculator is from Walmart. I think the cost is around $30. So remember, it's BA2 financial calculator. Right. Now, let's take a look at what you need to accomplish throughout the class. And first thing that I want you to do is look through the syllabus on D2L. Make sure you understand what you need to do to achieve a good grade. There will be 3 homeworks and 3 exams. 3 homeworks and 3 exams. And we don't have many homeworks, but for every homework, you have 3 attempts. 3 attempts. And the attempt with the highest score will be recorded. And the exam, you will have two attempts for each exams, and all exams are non-cumulative. That is good news. Right. And you will have 2 attempts for the exam, and the one with highest score will be recorded. And I want you to do the homework first, then exam. Right. And exam is very similar to homework. Practice homework for 3 times by doing all the 3 attempts will be a great way for you to achieve a better grade for your exams. This class is self-paced online course. You have 1 month. You have great flexibility and freedom to choose when to study and how to progress your study for 4 weeks. And here is my suggested pace. Here's my suggested pace. I do not expect you to put all the homework exams at the very last minute. I want you to go through every module for each week. So essentially you do 1 module for 1 week, and during every week I want you to read the chapters first, then look at the PowerPoint lecture notes and watch the videos along with the PowerPoint, then spend some time practice those homework questions. So by the end of the 3rd week, you pretty much complete everything. And I want you to have a relaxed 4th week so you can catch up something that you missed. Right? And although this is a self-paced online course, but I highly recommend you to go through 1 module a week. If you have any questions, I want you to put your questions in the discussion form in D2L or email me. Any questions? Okay. Now, let's take a look at what we needed to learn for the very first chapter of this book, and that is the Introduction to Financial Management. In this chapter, we have 4 major issues to discuss. The first one is basic types of financial management decisions. So we're gonna look at what a typical finance person need to deal with in working place on daily basis, and what is the role for a financial manager. And the second topic is the goal for financial management, or the goal of a corporation. The third one is financial implications for different forms of business organization. And the last topic has something to do with the conflicts of the interest that can raise between owners and the manager. We call this as agency problem. And here is chapter outline. Now, let's take a look at 4 basic areas of finance. And in finance, we have 4 basic areas. The first one is corporate finance. And here, finance people in a corporation do a lot of financial analysis, and they do a lot of financial decisions. And the goal of financial management within a corporation would be to maximize shareholders' wealth. And the second area is doing investments. As we know, most people have savings. Most people have 401k plan or retirement plan. And in the United States, we have more than 30 trillion US dollar worth of individual assets. And as finance people, you may have opportunity. You may have opportunity in the future to help others to manage their wealth. That is a second area called investments. And the third one is financial institutions. And in the future, if you are seeking financial career in finance, you may be able to find a job for a typical financial institutions. For example, a commercial bank like First Tennessee, Bank of America, Citigroup, so on and so forth, or an investment bank, insurance company, real estate trust company, mutual funds, private equity company, hedge funds, so on and so forth. And those are so-called financial institutions. And to run a financial institution efficiently, we needed to find a lot of talented, enthusiastic finance people like you. And the last area is international finance. International finance deal with international issues for multinational companies, and that is a surging area on the job market of finance majors. So we have 4 basic areas of finance, and as a practitioner in finance, I would say there's a 5th area that is so-called risk management. And risk management is another surging area where require finance people to find optimal solutions for individuals, corporations, governments, financial institutions to manage various types of risks by using a lot of different financial instruments, typically financial derivatives. Now let's take a look at second area to see what kind of job positions available for investment related financial management. And in this area, your job would be to work with the financial assets such as stocks, bonds, futures, options, so on and so forth. And your goal, your typical assignment is to evaluate different types of financial assets, and you need to consider the trade-off between risk and return. As a money manager, you probably need to figure out the optimal asset allocation for those financial assets. And the typical job positions in this area would be stockbroker or financial advisors. And a financial advisor is the most popular type of finance job available in Middle Tennessee. Other job opportunities including financial analysts and money manager or portfolio managers. In the financial institution area, those financial institutions are companies that specialized in financial operation, and it could be a bank, an insurance company, or brokerage firm. There are hundreds of thousands job positions in this area available across country on a daily basis. And fourth area is international finance, and this area where people specialized within each of the areas discussed so far. and you may be allowed to work in other countries on a regular basis, and you would expect a lot of international travel. And in order to provide international finance services in a foreign country, you need to be familiar with exchange rate and political risk associated with exchange rate fluctuation. Also, you need to understand the customs of other countries. Speaking a foreign language would be very helpful. And this is a surging area for finance majors in this country. So this picture showed you 4 very basic areas of finance. Now, why finance? Why finance? Well, there are many business majors that you can choose from. For example, marketing, accounting, management. But finance is one of the major that you can choose from a business college. And finance major typically will work in the finance department in a corporation. Right? Instead of doing marketing, accounting, or management work, the people majored in finance will do financial analysis and make financial decisions for a corporation. And business finance is essentially an area where people do financial analysis, make financial decisions within a corporation. So here, to take on the business finance role in a corporation, we needed to answer several questions. What long-term investment should a company take on? Where will we get the long-term financing to pay for investments? And how will we manage everyday financial activities of the firm? Those are typical questions that a finance manager in a corporation need to answer on a daily basis. And in a corporation, the top financial manager is called CFO, Chief Financial Officers, and the Chief Financial Officer will oversee treasurer and comptroller, and on the treasury department, it oversees cash management, credit management, capital expenditure, and financial planning. On the controller side, they look at taxes, do cost accounting, financial accounting, and financial data processing. And here you see a structure of a typical corporation. On the top, you see board of directors. It's pretty much like a Congress of our country, and that is the governing body of a typical U.S. corporation. And the board of directors are elected by all shareholders. Then board of directors will represent shareholders to pick executives such as CEOs and CFOs, so on and so forth. And CFO will report to CEO directly, and typically that is one of the vice presidents in a U.S. corporation. And under CFO, there are 2 different departments. One is Treasury Department, the other one is Controller Department. And the Treasury Department takes care of cash management, credit management, capital expenditure, and financial planning. On the Controller side, they take care of taxation, cost accounting, financial accounting, and financial data processing. There are 3 major decisions that finance people need to make within a corporation. First one, which is the most important one, is capital budgeting. Capital budgeting essentially deals with the question where long-term investments or projects should business take on. And the second most important decision is to determine the capital structure. How should we pay for our assets? How much money should we raise from debt holders, and should we issue new stocks, so on and so forth? And the last one is working capital management, which deal with how do we manage day-to-day financial transaction of the firm. Nowadays, businesses can be established based on several different forms, and here are 3 major forms of business organization in the United States. The first one is solo proprietorship, and the second one is partnership, and the last one is corporation. Last one is corporation. And most popular way to establish a business organization is through corporation, either through S corporation or limited liability company. And here is advantages and disadvantage for solo proprietorships. And here's the advantage and disadvantage of partnership. And last one is about the corporation. And the corporation, once again, is the most popular form for U.S. business organizations. And for a typical multinational company or international corporation, it's very likely that is established on the corporation perspective, and it carries limited liability, which means company cannot lose more than what shareholders invested. Now let's take a look at what a financial manager needed to achieve within a company. Essentially, we are talking about the goal of financial management, and this goal of financial management should be consistent with the goal of a corporation or goal of a firm. Should we focus on maximizing profits? It sounds a right choice. Should we focus on minimizing costs? Of course, if you minimize costs, then profit can be improved. Should we focus on maximizing market shares, so on and so forth? I mean, all those looks very reasonable goals for a corporation, but in theory, all of them are not correct answer. The correct answer is to maximize shareholders' wealth. Why? Because shareholders are bosses of a corporation, and corporations should do their best to serve their bosses' interest. So the common goal of any corporation is to maximize shareholders' wealth. Right? But practically, it's harder to measure shareholders' wealth. How do we measure shareholders' wealth? Should we use the number that you see on the balance sheet to find shareholders' equity? Well, that is not a proper way to measure shareholders' wealth. And on the market, people know that stock price reflect its intrinsic value of a company. So we probably can utilize stock price or market value of equity on the market as a proxy for shareholders' wealth. Therefore, maximizing shareholders' wealth could be equalized to maximizing the share price, right, the stock price, or maximizing the total market value of shareholders. Right? But I said we could equalize. Why I say could? Because stock price changes on the daily basis. Right? And we just say that the stock price could be a proxy for shareholders' wealth. Right? And there are many different ways for us to find shareholders' wealth, but no one is perfect. No one perfect. By far the best one is stock price. So the goal of firm would be to maximize shareholders' wealth. Practically, we would say it equalizes to maximizing stock prices, so that shareholders' wealth can be maximized. Right? So what can we do to maximize stock prices or shareholders' wealth? And here are several choices: outsourcing, offshoring, Aaron's case of making up numbers, and corporation support of charities, so on and so forth. And I mean, all of those things may directly or indirectly support the goal of maximizing shareholder wealth, but we need to analyze those individual activity on a case by case basis. For example, support of charity, right? I mean, support of charity will hurt shareholders' short-term interest, because cash is not going back to shareholders' pocket but to charities. Right? In the short term, shareholders will have less cash flow, but in the long term, support of charity may improve companies' future development, gaining the trust from the community, right? And that will actually increase the market share of companies' products or services. It could benefit shareholders in the longer term. So a lot of things are not conclusive when you look at both short-term and the long-term perspective. And actually, stock price will incorporate both short-term and long-term effects into consideration. And in most cases, I would say if share price is fairly evaluated by the market, then stock price would be a pretty good reflection of shareholders' wealth. And many companies focus on maximizing profits, maximizing good numbers that people want to see on the accounting statement or financial statement. And as we know, those accounting information or financial numbers can be made up by manipulations. And typical examples were Enron, Tyco, World.com, Adelphia, so on and so forth. And those companies actually made the numbers, and when they made the numbers, stock price soared. It looks like it's a very convenient way to increase shareholders' wealth, but actually it goes against the regulation of the market, and it's totally unacceptable in the business places. And in order to strengthen the regulation and internal control of corporations, the Congress passed Sarbanes-Oxley Act in the year 2002. The focus of this act is to strengthen the internal control to protect investors' interest against accounting fraud and financial malpractice. Now, let's move to the fourth issues for the first chapter, which is associated with the agency problem. Right? So when you take a look at the structure of a corporation, you know that the shareholders are not running the business directly. Instead, they elect board of directors, and the board of directors actually pick CEOs and CFOs to manage the company on a daily basis. So here, I would say the principle is shareholder, because shareholders are the bosses of a company, but they needed to found an agency to manage their businesses. Right? So the agency here are managers or executives in a corporation. An agency relationship describe the relationship between stockholders and corporation's executives. An agency problem means that corporation managers or corporation executives are not doing their best to serve their bosses or shareholders. Right? And essentially speaking, agency problem is the conflict of interest between principal and agent. And the principal here is shareholders, and the agent here is corporation executives. Right? Why there is conflict? Well, it's well known that human beings are selfish, and especially for those corporation executives, those CEOs, CFOs are selfish, right? And they have their own goals to achieve. They have their own agenda to work with, and their goals may not be consistent with a company's goal. So, what is a company's goal? Look, to maximize shareholders' wealth. But for most executives, their goals would be to maximize their own interest, right? So the agency conflict and agency problem will cost shareholders a lot of money, and we call that loss as agency costs. For example, incompetent CEOs pay themselves millions salaries, right? And sometimes they make business decisions not according to shareholders' interest, but based on their own interest, and all those malpractice will hurt shareholders' interest, and that is, well, agency costs rise. So we know that executives, CEOs, CFOs are not automatically working for their bosses or shareholders, right? But the shareholders really want them to work for them. So is there any solutions or mechanism that can motivate corporation executives to work, right? To work enthusiastically for shareholders? Well, there are many mechanisms that exist on the marketplace to help to make the goal of shareholder and the goal of managers consistent with each other. So far, one of the most important one is managerial compensation solution. Managerial compensation solution. And what a shareholder need is good performance, right? And what the manager need is higher salaries, higher bonuses. But somehow, if we can align managers' needs with companies' needs, then we can find a pretty good solution. That is managerial compensation package that can put both shareholders and executives in the same boat. So here, most companies have managerial compensation package that is linked to corporations' operating performance, right? And so that compensation package will give strong incentives to executives to do the thing that is right for shareholders, to do the thing that is good for shareholders. And a very popular way for that type of compensation package is to incorporate stock options, stock awards into managers' compensation package. And typically, CEO will have a pretty low amount of salary, and if CEO does a good job, then the bonus will be linked to the firm's performances, and the value of option awards, stock awards will increase if company does a good job and the stock price increases. On the other hand, if stock price declines, company didn't deliver good operating results, then manager will receive less because those option awards, stock awards value will decline to zero. And managerial compensation package is not the only way that we can align managers and shareholders' interest, and there are other ways. For example, corporate control, the internal control mechanism in any corporation, the auditing process, a bank that oversees a company's daily operation, financial analyst, media, so on and so forth. So there are many mechanisms that exist to help to align the interest of managers with shareholders. And the most effective one would be the managerial compensation package that aligns shareholders and the managers' interests. And here are more information associated with cash flows, financial markets, but we will learn a lot more details about those things in later chapters. So before we conclude this short chapter of Introduction of Financial Management, let's take a look at some quick quiz questions. Make sure you know the answer before you go to practice those homework questions. First one, what are four basic areas of finance? Well, those four are business finance, right? Investments, financial institution, and international finance. And the fifth one, that would be risk management. What are three types of financial management decisions, and what a question they designed to answer? Right? The first or the most important type of financial decision is capital budgeting. Capital budgeting. And also the manager needed to deal with capital structure, problem as well as working capital management. So there are three types of financial decisions that a company need to make. What are three major forms of business organization? And here we know that partnership, solo proprietorship, and corporations are three major forms of business organization. But the most popular one, not only in US but across the globe, is corporation. Corporation, and any corporation carries limited liabilities for its shareholders. Fourth one, what is the goal of financial management? Very simple, right? To maximize shareholders' wealth. Right? Sometimes it equivalent to maximize stock price, right? Or market value of existing equity for shareholders. I say sometimes, not always, because stock price may be deviated from its intrinsic value. So in equilibrium, if stock price is fairly evaluated by the market, then we can say that the goal of financial management would be to maximize stock price, because that is pretty much same as maximizing shareholders' wealth. Last one. What are agency problems and why do they exist within a corporation? Well, agency problem, agency costs are caused by the conflict of interest between managers and the shareholders, because everybody is selfish. Right? Manager will not automatically serve shareholders' interests. Right? And there are several mechanisms existing help to mitigate that agency problem, to minimize agency costs by aligning managers' interests with shareholders. Any questions? If not, let me remind you that we are jump starting a new course called Business Finance. This is an easy course in finance because this is a very principal or introductory course for any finance major, and also required major for all business major. It's supposed to be an easy course, right? And you do need two things to get ready. The first one is calculator. Right? It's not scientific calculator. Instead, it should be a BA2 Texas Instrument financial calculator. And the second one is the textbook. So next time when I see you, I expect you to get those two things ready, and also I want you to spend some time each every week. I would say on average you should spend at least 4 hours, right? Something between 4 to 6 hours each every week, reading textbook, look at the slides, PowerPoint slides, watch videos, and practice homework questions. Right, 4 to 6 hours each every week. You can distribute those hours evenly across the week, or if you are very busy at a working place, let's say you work Monday through Fridays, then you probably want to spend 3 hours each every day during the weekend, right? But it's your flexibility to manage your study in this online course, and it's self-paced course, but I expect you to go through one module for each week. Do not put everything at the very last minute. If you have questions, drop them in the discussion forum in D2L or email me. This is Kevin Zhao. It's my pleasure to serve you guys, and I will see you in next lecture.